People need an income that's guareteed to them.
If you lose money to taxes, you're never getting that money back.
You need to get serious about adding some lower risk.
Greed. I don't like greed.
The thing to be afraid of, honestly, is the thing that we're not thinking of, the black swan event.
There's a tsunami coming. Bye.
Welcome to Retirement Coffee Talk with Sharice Rivers.
Just coffee talk.
There's a lot of noise, a lot of chatter. Who do you listen to? Who do you not listen to? You have to stay focused.
A fun and informative look at the issues of wealth, retirement, and protecting your life savings.
These advisors out there that were trained to sell, and have all these fees. They don't want to talk about this product, so they make less money.
And now, Retirement Coffee Talk with Sharice Rivers.
Hello again, and welcome to Retirement Coffee Talk with Sharice Rivers at Zinnia Wealth. My name is Randy Cook. Each week, Sharice and I sit down here, talk through some of the issues that are going out there on Wall Street and what's going on in your world on Main Street. Yeah, all that stuff is swirling around out there with the politics and Wall Street and the interest rates and the economy. What does it mean to you? And what are you doing, and who are you getting to help you plan for retirement? That's why we have this show, and to introduce you to Sharice Rivers. Sharice, how are you doing today?
I am doing fantastic. You know what? If the government does a shutdown, I think the entire world should just shut down. Like, okay, you guys want to play games? The whole world's going to shut down with you, and we'll reopen when you reopen, right? Yeah, okay. We know that's not realistic, but hey, what if that was a holiday?
Yeah,
We'd all be broke. It'd be terrible for the economy.
Shut the whole country down. Huh?
At the rate of shutdown, because some shutdowns are super long, some are short. I mean, when you go all the way back to the 70s, it's crazy.
Yeah. There's been a lot of this, and I mean, so we could talk about this a little bit here because remember that we had Doge back in January and February, and there were about 150,000 or more people that decided to take the early retirement. And so those...
they decided to take it?
Well, sort of. and so those people right now are now going to miss their very first check because all of that ran until the end of September, and here we are now in October, and they are now saying, okay, I'm like retired now. How does this all work? And, there are other people that might be victim of that with this shutdown that we've just had. So I just want to take this in kind of a macro look a little bit and say these people are going to be kind of in an emergency situation. Mm-hmm. Retirement has been thrust upon me. Yeah. And that's not unusual outside government. That happens. People get downsized or something takes place. So I wanted to ask you about that. If somebody finds themselves in that situation and it's been thrust upon them, what is it? What's the bullet points, the order of things that you sit down and talk to people about?
Well, number one, those 150,000 people, I bet less than 10% actually sat with a financial advisor to see if they could retire first and or if they had to go find a new job depending on their age, right? Mm-hmm. And then they wait till the final hour and they're like, now it's time to panic. And we've been on siesta time. And so, we have had people come into our office on many occasions saying, well, Sharice, I should have come in and seen you years ago when I've been listening to you on radio, start planning because I just got shut down and my last day was last week.
Oh, boy.
I get it a lot.
Okay.
And so it's so much more fun when you come to me earlier and we plan this. But there are things you have to look at. And so the first thing we look at is your income. Mm-hmm. So... and your age, right? Are you 50 or are you 62?
Okay.
Right?
Okay.
That also makes a big difference because if you're 50, you're probably going to have to keep working. If you're 60, you could probably retire. And this is a real concept here, right? Because it depends how much you saved and how much you spend. So we have to take number 2, inventory. Do we have a mortgage? Do we have to buy another car? Do we need our roofs done? What do we need done over the next 5 years? And where do we pull those dollars from if we were to retire in year 55 right now, right? And if we do and we build the income plan and we look at your fixed incomes, we look at the assets you saved and we look at the debts that you have and we say, okay, we also need another car. And we look at all this stuff. A lot of times we're going to say, hey, here's the plan. And if you do this now and you need all these things, you're going to run out of money, all this money you've saved in 15 years or 20 years, right? And if you're 55 and you run out in 20 years, I don't know, 75, most people are living longer than that. But so you want to be really careful. And you also want to plan, because you never know when somebody's going to say, okay, your time's up. We got to let you go. And here's your golden ticket, right? Yeah. And so we have to look at all those pieces. But I will say my goal here, our goal here, is to try to get people retired earlier than ever planned. Mm-hmm. So many people have come in and they have been able to retire, and they were stressed out. They would come in and see us 3 months, sometimes 6 months after they were laid off at that. And they've been looking for a job the whole time. And then they come in and it's like, before I look for a job, maybe we just need to ask Sharice or her team, can I retire, or do I really need to look for a job? Or maybe can I go part-time? So then people start coming in. It's an oddity here, because I see it all different phases, just depending what the goals are. And I will admit, probably 7 out of 10 times, people did not have to go to work, or if they did, it would be part-time, which was interesting. So again, remember, it's based on a lot of things.
I want to ask about healthcare, because that's a big issue. You talk about that person who's 50 or 55. They got a long time to get to Medicare. My neighbor worked for AT&T, and he took one of the early packages, and the early package, from 62 to 65, they paid for his health care. He got health care free. They got him to Medicare. I thought, wow, what a nice benefit that was. Yeah. But that's not always the case, is it?
It's usually never the case.
Nobody's that nice, right?
Unless you're 63 years old and coming around the corner, right?
Got it.
Corner birthday coming. So you have to worry about healthcare too. And so I have a great scenario. I retired a client about officially 2 years ago. Mm-hmm. And they had come in and seen me, a husband and wife, 4 years ago. And the husband was turning 65 and the wife was turning 55. And for him to retire, because he had some health issues, the missus said, I'm going to keep working. She had a great job for the next 10 years and I'll retire at 65. And that was built into our plan. Mm-hmm. But each year thereafter, she would lower that 10 years a couple of years. And remember, now they're clients for about 4 years or so. And that 10 years is down to 0 years. She's like, Sharice, I want to retire with my husband. And I knew for a fact that couldn't happen. Like, that is the worst conversation I could ever have with somebody. So I had to show her the math. Be like, listen, if you went part-time and then you decided to spend less in retirement, this is doable. But I know you probably don't want to spend less. And she's like, no, I don't. And I did want to retire my husband early because he was already 65. And when one spouse retires, the other one has FOMO and they see them retired and they're like, oh, I want to enjoy life with you, which of course you do. Why? And that's what we should be doing. So we really have to plan this out accordingly. And if you are 50 and let's just say you think you're going to retire at 55, I hope you have a written plan that shows that, hey, those dollars you have saved and the income you have coming in will actually be sustainable for the next 40 years in case you live to 90. So you really have to roll everything to age 90. People are living longer, and it could even go much further than that. And if you haven't and you're considering it, let us test your plan. We stress test your retirement. My number one goal is I want to get you retired earlier than you ever imagined, and I want you to spend more than you ever imagined. So can we do it? And then we start to test it, right?
Well, I think that one of the big regrets you find if you talk to people in retirement, say, do you have any regrets? And they said, I should have done this earlier. And so to retire earlier than what you thought, you might be scary, but what if the math all works out? And we won't know until we actually sit down and really start crunching numbers. And we say it every single week here on the show, and we've been saying it for 13, 14 years. Let's do the math on your retirement.
Yeah, let me say something to the listener, especially if you're listening on podcasts. Are you sitting at your desk, looking at your phone, waiting for that hour to pass so you could leave? Are you that manager that is working with new young people that always want to be on their phone and you don't know how to manage that because that's a new thing for you because maybe you've been at that employer's location for 30 or 40 years. I know who you are. I know how you feel. We go through that too. And so you can't change things and the way things are moving forward. But what you can do is see if you can get an exit out of that and let one of these younger people step into your spot. We talk to people all the time about that. They're like, I can't keep up. I don't want to keep up. I like my old school way. They're bringing in new technology. I don't want to learn this artificial intelligence. And then some people are just like, I'm done. But they're done and they haven't created a plan. So I know some of you are listening and you're thinking that right now. So please, we understand you. And I'd love to talk to you about it.
Give us a call. Let us run the math on your retirement. We do a complimentary, no cost, no obligation look here on what your retirement looks like. What do you got? What have you saved? What do you want to do? Let's put the dreams together with the numbers and the money. It's 833-368-3680, 833-368-3680, or use our website, ZinniaWealth.com, ZINNIA Wealth.com. There's a gold box. It says complimentary retirement consultation. That's exactly what it is. Click on that. You'll be on your way. All right, so we see the big fears about retirement. Of course, year after year, it's I'm afraid I'm going to run out of money. But creeping up there right near the top, and sometimes even taking that number one slot, is people worried about the price of things, inflation. It's still, even though inflation has gone from 9% down to 3%, hey, the price of meat at the grocery store is crazy. My wife is a big coffee drinker. There's a tariff on it right now, and coffee has gone up like 40%. I mean, you can't tell me that prices aren't going up. Some things have gone down or they've leveled off, but it's still out there. And so I wanted to ask about inflation a little bit. You tell me that you put inflation into every retirement plan, but do you put inflation for retirees? Because I think people 60 plus are spending their money in different places than people who are younger. For instance, eating out has gone up 5%. Travel costs are up 8%. Nursing home, health care at home, all of these things have gone up. As a matter of fact, Medicare next year, Part B, is going to go up 11%.
Yes.
This affects retirees, doesn't affect everybody else. Talk to me about inflation and how you write that in.
Right. So the government understands this and they see it. So when inflation is up, even though it's down considerably from where it was, rates go down to help with the inflation rate, right? And so knowing that, they're trying to help, but it can't last. And whenever we build an income plan for people, Randy, we will test it a couple different ways. What does the plan look like at 3%? What does the plan look like at 4%? And then we'll go to 5%. A lot of people don't want to go any further than that because, that's kind of where we can average out. We don't really know the future, but, inflation, it's a supply and demand thing.
Well,
right?
Historically, if you look at inflation maybe over the last 70, 75, 100 years, the
3.5%.
It's 3.5%. Yeah, it's 3 to 3.5%. That's normal. And so when we went up to 9, that's crazy.
Well, that's right. So that's a but. So here's the other part when it comes to that inflation rate, Randy, is that let's look at the inflation over the last so many years. We had a huge jump up. Now inflation is at bay, but we still have this big bubble of inflation that will never go away.
Yeah, once prices go up, they stay up. Yeah.
They stay up. Yeah. And so there's a miscalculation and all that, in my opinion, when they do the math. So I like testing the 3% and the 5% just in case, because it feels more like 5% to most people today. And it depends when you retire on that inflation rate as well, and what the economy is doing, how much you made in your investment. So it's kind of like a three-legged stool when it comes to inflation that you have to look at. And testing all three of those legs will actually probably help you sleep a little better at night, compliance-wise. I can't guarantee it, but just seeing the outlook, you can really test your retirement plan on, okay, if it goes up and we have another bubble, blah, 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 I'm still going to survive it based on maybe a 4% rate of return on a pessimistic view, right? So we can play that game and see where we land.
Yeah, just simple Randy math here. The average person, and I'm into all the numbers, spends about $6,000 a month in retirement. Well, if inflation went up 3%, that's another $200. That's, every year it's going to go up. And instead, in a very short period of time, instead of $6,000, you're going to need $7,000 a month. And where is that coming from? Is that built into your plan?
Yes.
Well, if you sit down with Sharice, yeah, it is. It's built into your plan.
It is absolutely built in your plan because we do an inflation adjustable income every year in that plan. So we'll start at 3% a year and then we'll test it at 4% a year. So your income's going up at that rate every year because that's the need we're expecting you to need so that we know those dollars are in that pot that you save for and continuing to grow the way it needs to grow. I mean, but think about it. Medicare Part B, 11%'s pretty steep, right? 11% on Part B, and then the next year it goes up again. Maybe it's down the next year, but eating out 5%, I don't know. It's okay. It is a medium number, in my opinion. It's still higher than I'd like it to be. Traveling costs, it was higher. 8% is still not a good number, in my opinion. You go to certain areas in the country too, or even in Florida, it's like double the price than it was in 2019. And that is a double inflation, right? That will never go down. And the biggest part, you guys, hear me out. Nursing home costs are up 9%. Listen, over the next 15 years, this is a projection. If a full-blown nursing home right now, 24/7 nurse, costs $7,500 a month, which is an average right now, but it's really $7,500 a month to $10,000 a month. Yeah. But if it is at the cheapest motel you can find for a nursing home, $7,500 is going to go to $15,000 on average in the next 15 years. So talk about that inflation rate because who's going to pay for that, right? And I don't believe in these long-term care policies out there because most people don't use them, and or if they do use them, they're still out of their pockets with more money. And then there's all these stinking rules you got to follow. And it seems like 1 out of 50 people use their long-term care policy. So we do have to look at alternatives and other ideas when it comes to that. But home health care, nobody wants to go to a nursing home, Randy. And home health care is up 10%. That is expensive. I was not expecting to see that. But when you're getting home health care, you would always rather have home health care before you go to an independent living facility or a nursing home. But the nice thing about home health care is most people start that when they just need a little bit of help. So you might have somebody come in 8 hours a day just to help cook, maybe a little bathing, all those things you don't really want help with, but you need the help. But what if you need it overnight? Costs get more expensive. So 10% is super, super high. So I feel for the retiree. We do plan that nursing home healthcare phase of life. Talk about teeth. People forget about teeth in retirement. Seriously.
I know.
Most retirees want the implants, right? If they can afford them. And the cost is so sky high. And so if that's you, we got to build that into the plan. I learned years ago, I was like, Sharice, we had these plans and we didn't schedule the teeth in there. I'm like, gosh, I didn't even think about that part. It was years ago. I'm like,
one tooth, $5,000, baby.
Oh my gosh.
I'm telling you, I've been there.
So we really have to think about those hazards that are upon us over the next 30 years while we're retired and build them in.
You're listening to Retirement Coffee Talk with Sharice Rivers at Zinnia Wealth. Online, zinniawealth.com, ZINNIA wealth.com. If it's time to talk about your retirement, if you're thinking about retiring, if you wonder if you can retire, come on in. Let's do the math. We'll do a no-cost, no-obligation meeting. We call it a complimentary retirement consultation. You're going to see that on our website. It's by a gold box there. So go to zinniawealth.com and click on that gold box. You'll be on your way. Or 833-368-3680. All right, so every year they do studies about how confident are you about retirement. 2 years ago, 39% of people said it'll take a miracle for me to retire comfortably. They did the same thing recently. Today, that number is 21%, so almost cut in half. And so you say, well, what's the big reason for that? And the article pointed out the stock market. The stock market is up 40% in the last 2 years. So people, Sharice, are pinning their retirement dreams and confidence on how well the stock market is doing.
That's a rule breaker in my office.
Seems a little dangerous to me.
You don't want to dictate your retirement plan based on what the stock market does or doesn't do. So that just tells me you don't have a written plan.
Yeah.
That just tells me you're with the stock jock. You're not with the retirement planner. Therefore, we have probably a little less confidence, and we feel like we have to be forced to go into that stock market. And then nobody's coaching you how to get out of the stock market and still have a reasonable rate of return. So this is the story in the financial services industry, and it's very frustrating. And, if you look at the last 2 years in the stock market, 40%, that's a good rate of return, right, Randy?
Yeah.
But did everybody actually over the last 2 years make 40%?
I didn't.
And the answer is no.
Yeah.
The answer is no. Most people on average did maybe 12% the first year and 12 to 15% the second year. So what is that? That's only 27% out of 40%. Where's the other money?
It's really good, though. That's good.
Yeah, totally good. I'll take that all day long.
Yeah.
But that's the price to admission when you get in the stock market, because the stock market goes down 10%. You have to make 11% to get back to even. If it goes down 30%, you have to make 43%. And that could take literally 4 to 5 years, which we saw in the 2000 crash and then the 2007, 2008, and 2009 crash. So the bobbing and weaving is what hurts you. And so I have a great scenario. If I go back literally just a little over 2 years, the S&P, if it did 40%, it did the ups and downs, and so do yours. But most people are not invested 100% in the S&P 500, Randy, right? So if you have a 60-40 portfolio, maybe only, for example, I'm just doing examples right now, 60% was the S&P and the other 40% is in an aggregate bond to split it up, right? And so now you're going to get the bonds that were not doing 100% A-OK from time to time. And then you got the S&P that was doing okay, bobbing back and forth. So to only make 40% truly is being the S&P 500. So here's what I want to say about that. What if you got into, and I don't want to say the A word, but I'm going to say it because this is what happened to a few of our clients. Timing is the essence. But what if you got into a very specialized annuity that doesn't have fees, annuity that only allows you to invest in the S&P 500, and an annuity that could never lose when the market goes down, and an annuity when you die, 100% goes to your beneficiary, and an annuity that allows you to take withdrawals every year so it's not locked up. And what if that annuity did a 57% rate of return over those 2 years?
Wow.
I'm not allowed to even say what the return was with some of our clients, but I'm giving you that number for a reason. So I'm kind of skating around the bush here. It is the timing. So because the money was in the annuity, that those people parked their money in that annuity when the market was down, and then the S&P, and it just grew, right? And if you can make reasonable rates of returns, that is still rather liquid and safe. Why wouldn't you split up your strategy a little bit? And here's the thing. Do not go out there and buy annuities, you guys, until you come and sit with me, because out of the thousands, there's only 3 we like across the entire country. And the ones we like are the ones that are making money. Okay. So buyer beware. So it's a timing thing. And so to have confidence, I think you have to have a built-in income plan, a strategy, a tax plan, the right investment plan, the right asset allocation. A 60-40 portfolio is not, in our opinions, the best and only asset allocation. That is the stock jock, buy and hold, say la vie. I'm going to collect my 1% commission or my 1% fee every year and follow the 4% rule. And that's not how we roll here. There's an actual retirement plan, because there's 30 years we've got to do some bobbing and weaving. So we've got to get a little creative, and we really have to look to the future a little bit more.
Don't pin your retirement success on the success of the stock market. There are other options for you. You don't have to be 100% invested and say, I got to get 12% to retire. That's probably a little too far of a reach. Let's sit down together and do the math on your retirement, figure out what you need. What kind of return do you need in retirement? Is it 3%, 5%, 7%? Let's work through that. Here's our number, 833-368-3680. 833-368-3680, or online, our website, ZinniaWealth.com, ZINNIA Wealth.com. Click that gold box there. It says complimentary retirement consultation, And that starts the conversation. So how much do you spend in retirement? Everybody wonders, how much money do I need in retirement? And well, okay, let's dive into that a little bit. There's that one rule of thumb that says you'll spend 70 to 80% of your working year's income in retirement. And actually, when you look at the data, sometimes that really does hold up. So that might be one you look at there. But there's some new research here on how and when you spend your money. I thought this was interesting. Your spending peaks in your lifetime in your 40s and 50s. That's when your kids are in high school and they're going into college, and there's a ton to be spent there. Maybe some of your kids are getting married at that point. Lots of expenses there. And then when we get into our 50s, we start going, holy cow. Retirement's not too far away. I got to save. And so people cut back a little bit, and then they start pushing money more toward retirement. And then you get into retirement. And Charisse, talk to me a little bit about what you've seen about when people, they're at the starting gate. Does it take them a little while to ease into it? Or do they kind of go, I'm ready, let's go? What do you see?
You know what? That's a great question, because some people, we build out plans all day long and we front load retirement. The first 10 years, your go-go years. So let's go, let's spend money, and we'll pull back the reins when you're 70 a little bit. When things start hurting or health starts to maybe deteriorate. So let's do it while we can. I get people, we build the plan and then we have our reviews. And I've realized I'm looking at their money at Fidelity or wherever we have it located. I went, you didn't take any money this year. I was like, what happened? They're like, we didn't spend as much money as we thought. I'm like, but that was not the point. I said, we built it in to why didn't you go? And they said, I had honey-do lists, or this came up, or this came up. And then there are some people that are like, Charisse, give it to me and give it to me now, honey. Right? So I get a mix. And like literally this past week, I did a review, and they were supposed to start taking $50,000 a year, and they only took about $20,000. And I went, okay, so what are you going to do with this other 30? Do you have a new car? Do you want to gift it to the kids? What are your thoughts? This money was intended to be spent based on what the 30-year outlooks might possibly look like for the legacy. And they're just like, oh, I know. Maybe we'll save it for next year. And so we just have these ebbs and flows with clients. And sometimes they're really ready. And sometimes they're such good savers. They actually have a hard time saying, okay, I saw the plan. She said it's okay. And some of them, it takes a couple of years. And I know that for a fact. I'm on with a client right now in the third year. And they're finally like, okay, I think I could spend this money. I'm like, yep, sure can. Still in your plan. Now you get to take more money than you were going to do 3 years ago. And they're like, okay, well, I'm ready. Let's do it. And everybody has to walk that retirement journey at their own pace, right? And we'll walk it with you, but I will be nudging you the whole time, because I'm the one who sees people, their health deteriorate way sooner than I ever imagined. And we don't know when and who that's going to be. Some people live a year and they pass away, and then the spouse is left alone in the house and they didn't even get to do their traveling together. So this is why I just ooze, let's get you retired earlier if we can make it happen with these plans that we build out. Because I've seen, and I never thought 20 years ago, Randy, I would have seen what I have seen. And all the things that can take place that I didn't realize could happen so soon. The things that I see people go through, I assumed back in my day, it'd be happening in the 80s. No, I see it in people's 50s and 60s and 70s. And when you're 70, you're like, gosh, I have saved way more money than I have ever imagined. Now I want to start spending. But now you're like, I can't even get off the cruise ship in Alaska and do the ground tour because of something or another.
Yeah.
So
a hip or a knee or something like that.
Yeah, and it's why I'm so passionate about, like, get in here, let's see what we can do, let's have some fun with it, and let's get you retired.
Well, what you're saying is exactly what they found in the data here, is that spending in retirement is, and they use the word volatile. 1 year it goes way up. Other years it goes way down. Sometimes people will take a big trip and then they say, okay, let's back off now because we don't think we can, the bucket's not going to get filled up, even though it is. Or the spending. So the spending goes up and down. One of the things they talk about here, and you've talked about this in the past, is spending in retirement's kind of like a smile. It's really a lot at the very beginning, and then you do all the trips and all the stuff that you want to do on your bucket list, and then it goes down a little bit. Then you just kind of chill for a little bit, and then then the healthcare stuff starts to kick in, and then things go back up again. So another thing that came up in this survey is what they refer to as partial retirement. And you just mentioned this not long ago, of couples who might have an age gap, and one is 65 and the other's 55, or one is 70 and one is 60, or there's 5 or there's 10 years between them. One retires and the other one's still working. I got to believe that there's a lot of challenges that come with that when it comes to the planning aspect of it. And I mean, you mentioned that story before of the spouse who is not retired yet, and they get a little jealous seeing, the other one going on trips or sleeping in until 10.
Yes.
They don't like to, I want to be a part of that. And so talk to me a little bit about that.
Ladies and gentlemen, and ladies specifically, if you're listening, send this to your girlfriends.
All right.
Listen, women tend to live longer than their counterpart, aka men, right? Mm-hmm. And most women, a lot of your husbands are a little older than you. And on average, ladies can live 7 to 10 years longer, right? And so we're going to lose a Social Security check. Of the 2 Social Security checks coming into the household, if you're both collecting, one of them goes away. God forbid we lose a pension or even half a pension. And if you do lose a Social Security and part or an entire pension and your spouse passes away, do we have enough in that nest egg to cover your lifestyle, right? So we have to start thinking about that. And then here's the icing on the cake. Ladies and gents, but ladies, your taxes can all nearly double because you're not filing married jointly, you are filing single, and now your standard deductions cut in half and your marginal tax bracket went up, yet you lost 25% of your income because one of the Social Security checks went away. So that's a whole nother element that most advisors don't talk about, nor do they care. And they're like a deer in the headlights. They're like, go to the CPA. And the CPAs aren't even talking about this. This is why you come to a tax strategist that actually understands that, because we're doing it for all of our clients. What if you pass away and taxes go up? What do we need to do now to keep taxes down in the future if it were to happen? So it's just not about your income. It's about your tax plan. It's about the investment plan. It's how much you're spending now, how young you are. Do we have debt? Are you going to buy another house? I'm going to tell you, lo and behold, ladies, you all decide to upgrade your homes in retirement. I've learned this and I've just gone with it. But everybody wants a bigger home. You're retired, and within a couple years, like, we're going to buy a bigger home. And I'm thinking, don't we downsize in retirement? No, I will say 75% of people we see, there's another home that is purchased, and it's usually a bigger home and a nicer home, which has become a shocker to me over all these years. And then if a spouse passes away early, depending on where the real estate market is, then you're probably going to downsize. You're thinking, well, I don't have as much income. I got to downsize. Now I got to sell this house at a lower price. Sometimes we're in the hole. And these households, if you guys do live a long time together, you buy this bigger home, and then I would say in less than 10 years, you're selling it and downsizing anyways. I call that the definition of insanity. Yeah. But
I get it.
But, I'm not in retirement, and maybe I do the same thing. I don't know. But we have to plan for those costs. And there are areas when you're doing that could be derailed. I had a client that really derailed their retirement plan because they're like adamant, we need $500,000 from this account, Sharice. And I'm like, okay. And they're like, we're going to spend less and blah, 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 blah. And I'm like, I'm worried about you guys. And they did it. And they're still in the house. They are 80 years old right now. And now they want to move. And gosh, at 80 years old, who wants to move? And they ended up dumping more money in the house than they ever planned. And some of that money came from their IRAs. And it's just, we will advise till we're blue in the face. But you get to do what you want with your money. But I will show you the path, and I'll show you how it could get derailed. And if you get lucky, this is where you could be also, if it's on a positive note, right?
Yeah, that whole idea of, women living longer than men. I mean, there's, in my family alone, I'm looking at, I was just figuring while you were talking there, my one grandmother, 16 years alone. My other grandmother, 22 years alone. My mom, 23 years alone. And that's a lot of alone time and a lot of adjustments to make after you get into your retirement years. So these are the things when we talk about spending in retirement, everybody's worried about, did I save enough money? Did I do this right? Is my money in the right place? The only way to know is to really to sit down and go through that. As we say every week, let's do the math on your retirement. We'll do a no cost, no obligation meeting with you. Both of you come to the meeting. Let's figure that out together and sit down and say, this is what you've done for retirement. This is what you want to do in retirement. Let's put the two things together here. See how long this money lasts. If you like that number, fantastic. Let's go. If you don't like the numbers, let's rework it and figure out how we can get to the place you want to be. Here's our number and here's our website. Give Sharice a look on the website, zinniawealth.com, ZINNIA wealth.com. And there's a gold box there. It says complimentary retirement consultation. Click on that. You'll be on your way. Or just skip all that and call us. 833-368-3680. 833-368-3680. We've talked before about some of these hard and fast rules of retirement. We just talked about one that probably would work for you, the 70 to 80% of your working year's income. That might be one you look at. The 4% rule is one that's been around a long time, and we've kind of debunked that a little bit here, that's the whole idea of if you just spend 4% of your money each year adjusted for inflation, you will never run out of money. That's the rule. And Barron's decided, okay, let's look at some years when the market was really funky. And they picked 1969. So apparently that was a pretty volatile year in the stock market. So they said if you retired at the end of 1969, your money lasted 35 years. But if you retired at the beginning of 1969, your money ran out in 26 years. So
we're talking about a time where TV was still black and white, right?
That is going back a ways, isn't it?
Okay,
that truly is. But in any event, I mean, this brings up what we talked about. I mean, we just mentioned it. Don't let your retirement be dictated by the stock market. So if you're 100% invested, this is what you're up against. And I mean, this brings up the idea we can't many times control when we retire. Because sometimes that's forced upon us. We talked about that today. But we can control how our money is invested. So talk to me a little bit about that. This is the person who retires and they walk out and they're happy and then the market tanks and they're like, oh my God, what am I going to do now?
Okay, so I'm going to test everyone out there. So if you're driving your car, maybe pull over or just get ready because I want you to paint a picture, like right now. Pretend you're meditating and I'm forcing you to do this and you got to really chill out for a second. Okay. I don't know if you're 50 listening or 55 or 60 or if you're 70, right? Maybe you're 80. So what I want you to do is think back to the year of 1999. Okay. From 1980 to 1999, the Dow Jones grew over 1,000%. And you're like, man, we just keep making money, right? And so this is where the 4% rule was born because markets were going up, up, and away. But they don't always go up, up, and away, but that's what happened during that time period. So now it's 1999, and you and your spouse said, it's time to retire. We're going to collect our Social Security check. We have between both of us $50,000 in income from that, and we saved this grand old $1 million in our 401k. And now we're going to follow this 4% rule because these stock jock who you've been working with for the last 20 years helped you grow your money. And you're saying, okay, well, I only need 40 grand more. So my 50,000 Social Security and then 40,000 for my 401k. I have $1 million. Then I will never run out of money, Mr. and Mrs. Stock Jock. That is right, Mr. and Mrs. whoever you are. And then you turn in those keys to retirement in 1999, and you wake up in the year of 2000, and you got your Social Security check, and by the end of 2000, you've collected your 40 grand. And what was happening in the year of 2000?
It was.
From the year of 2000 to 2002, that was a 33-month decline. Now, here we go. You guys still paint the picture. Pretend we are in 1999 right now. And tomorrow we wake up and it's the beginning of 2000. And this picture really needs to be painted for the person who's actually living on their investment right now. And now I want you to think 33 months from now. Where is your money invested today? Where are you pulling the money from? Are you in a 60-40 portfolio? Because bonds went down, equities went down, and the cardinal rule is do not sell anything from your investments when the market goes down. Yet your 401k, because you pulled that 40 grand out, 2000, 2001, and 2002, and the stock market went down, your 401k is officially a 201k. Now, 33 months later, what do you think you did? Well, you probably kept living on your money because nobody taught you this thing called sequence of returns risk, which is AKA the word for I am now afraid to run out of money because I saw this happen to friends and family. And then the bottom, and then it took 5 years to crawl out of the hole. So let's say you're 65 right now, you're collecting your checks, you're in the same scenario. 33 months later, your 401k turned to 201k. So now your $1 million is $500,000. And over the next 5 years, you are not allowed to touch your money while that $500,000 is recovering to $1 million. Because when you lose that kind of money, it takes 4 to 5 years to recover. So mitts off the whole way down and the whole way up. So that was 7 to 8 years. You couldn't touch your money. So where are you pulling your money from? Nobody's thinking of that, Randy. Listen, I'm not telling you the market's about to fall out. I'm telling you one day the market's going to fall out, and I need you to start thinking about that. So I believe most retirees should have 5 years of income baked into something that cannot lose when the stock market goes down. So you do not have to change your lifestyle, because I promise you this much. If you don't plan for this day, you're going to be pacing up and down the hallway at 2 o'clock in the morning saying woulda, coulda, shoulda. And I say this all the time. If you tell your spouse, your wife, that we cannot book a trip for 5 years, you're in big trouble, buddy. Yeah. Happy wife, happy life. And all kidding aside, this has happened. So we have to plan. That's what we're planning for here. We're stress testing your retirement. We're finding different ways to make a rate of return in 5 different buckets. Some buckets won't be harmed by the stock market. Some buckets could be harmed by the stock market. And we're just getting creative so that this epidemic that took place and the worry of running out of money doesn't happen across the country again. And there's other advisors like me practicing the same practice, which is great because the stock jocks are getting a little bit better.
It's interesting. You know, you mentioned 1980 to 1999, market goes up 1,000%. So everybody was probably pretty thinking, hey, the market can do nothing but go up.
Right.
And then you got 2000 to 2002 with the tech wreck. Goes way down. Yep. Then in those 5 years that you say you have to recover, then what happened? 5 years later, 2008, 2009, subprime mortgage crisis went down even more.
That was the S&P dropped in 18 months. It wasn't even 33 months this time. It was 18 months that S&P dropped because that subprime mortgage crash, 51%. And then it didn't take 5 years to recover. It basically took close to 4 years to recover. But still, that's 6 years. I mean, that is a double whammy. And I went on a tangent because during that 2000 era, 2000 to 2010, that was called the lost decade. And if you follow the 4% rule, you were in trouble because 2000 to 2010, the average was 1.8%. So every year, if you're taking out 4% and then the average is 1.8%, you're taking way too much out based on the rate of return that's actually happening out there. So this is that time period why so many people fear running out of money, because nobody knew it was going to happen, and nobody knew it was going to happen twice. So,
I mean, let me put it to you another way. Okay, let's say, for instance, in the year 2000, you had a child, and that child was 15 years old before you got your money back to the same spot that you had it in 2000.
Yeah.
That is incredible to think about.
Well, and here's the other thing you need to think about. Some of you are like, what is she even talking about? We're talking about the people who retired during that time period. Now, if you were working and you still kept your job and your employer didn't fire you because of the economy, well, you were in a growth mode and you were building wealth like crazy, because every time that stock market went down every 2 weeks, you were plugging money in that 401k and buying stock at a low cost for that 33 months. So for some people, it was a wealth building. You weren't retired yet. And those people, I'm talking to you, you haven't seen a real crash. Now you're retired and you went through it. You got your paychecks. You made more money than ever because you're just contributing and you're in that accumulation phase. And now you're about to embark into this decumulation phase where you're living on your money. It's a different strategy. This is why it's important to work with a retirement planner that understands this. You go from the accumulation advisor to the decumulation advisor. Bottom line.
Well, you know, that period of time you said 1980 to 1999, there's 19 years. Think about how far we are now away from 2008. 17 years.
Right.
Yeah, we saw a pullback during COVID, but that only lasted about 3 to 6 months. Yeah, we saw another pullback when the tariffs, but that only lasted 2 weeks. You know, we are really very much due for something, some kind of a bear market. A bear market is a 20% pullback that lasts longer than 3 months. And so this is, it's out there. It's not a matter of if, it's a matter of when. And you look at your accounts right now, and I want you to look at that account. You got that number in your head right now? Now take 20% off it. How do you feel?
Right. You got $1 million. You just lost $200,000. How does that
feel?
Yeah. How does that feel? Number one. And if, you know, the one thing you have to consider, if you make 20%, your 1 million will go to 1.2 million. You're not going to change the way you spend. You're not even going to go out. You're not even going to go out and go buy that brand new RV. But if you have $1 million and you lost 20%, that 200,000, now you're at 800,000, I guarantee you're going to change your lifestyle.
Yeah, exactly right. We don't want that to happen to you. We're not trying to be, you know, fearmonger and the market's going to crash. Blah, blah. No, that's not what we're saying. That's not what we're saying at all. What I'm saying is look at the number that you've got right now, knock 20% off of it. What is that feeling in your gut like right now? Ugh. How long did it take you to save $200,000? A long time. So let's not lose that. Let's put a floor under that. Even if you're a couple of years away from retirement, let's not wait. Let's sit down and have the conversation about protecting your money, growing your money, building income for your money, having a tax strategy for your money, the legacy planning aspect. Let's get it all out on the table. 833-368-3680 is our number. 833-368-3680, or use our website, zinniawealth.com, ZINNIA wealth.com. Hit the gold box. It says complimentary retirement consultation. That's just basically a meeting. It's where we sit down, get to know you, and see what have you done for retirement? What do you want to do in retirement? Let's put it all together. Again, 833-368-3680. Sharice, that is all the time that we have on this one. I'll give you the last word.
Again, we appreciate you guys. Have a great weekend and live by design and not by default. And we'll see you here next week.
This has been Retirement Coffee Talk. To find out more about how the strategies we've discussed on this program can build the retirement you've been wanting, call Zinnia Wealth at 352-368-3680 or visit us online at zinniawealth.com.
Investment advisory services offered through Zinnia Wealth Advisory, LLC, a registered investment advisor. The firm only conducts business in states where it is properly registered or is excluded from registration requirements. Registration is not an endorsement of the firm by securities regulators and does not mean the advisor has achieved a specific level of skill or ability. Insurance products are offered through Zinnia Wealth Management, LLC, Florida license L078655, and Sharice Rivers, Florida license P037744. Zinnia Wealth Advisory, LLC, and Zinnia Wealth Management, LLC are affiliated entities. The information presented is believed to be current. It should not be viewed as personalized investment advice. All expressions of opinion reflect the judgment of the presenter on the date of the podcast and are subject to change. The information presented is not an offer to buy or sell or a solicitation of any offer to buy or sell any of the securities discussed. You should consult with a professional advisor before implementing any of the strategies discussed. Any legal or tax information provided in this podcast is general in nature. Always consult an attorney or tax professional regarding your specific legal or tax situation. Any client experience discussed on this show are unique to that client. Annuity and life insurance guarantees are subject to the claims paying ability of the issuing insurance company. If you withdraw money from or surrender your contract within a certain time after investing, the insurance company may assess a surrender charge. Withdrawals may be subject to tax penalties and income taxes. Persons selling annuities or other insurance products receive compensation for these transactions. These commissions are separate and distinct from fees charged for advisory services. Insurance products also contain additional fees and expenses. Social Security rules and regulations are subject to change at any time. Always consult with your local Social Security office before acting upon any information provided herein. References to specific investments should not be construed as being past-specific recommendations. The returns for various indices discussed in this podcast do not represent the performance of the firm or any of its advisory clients. Returns do not reflect the impact that advisory fees will have on an investment. Past performance may not be indicative of future results. All investment strategies have potential for profit or loss. Different types of investments involve higher and lower levels of risk. There is no guarantee that a specific investment strategy will be suitable or profitable for an investor's portfolio. Historical performance returns for investment indexes and/or categories usually do not deduct transaction and/or custodial charges or advisory fees, which would decrease historical performance results. There are no guarantees that a portfolio will match or outperform a specific benchmark. Investments in fixed income products are subject to liquidity risk, market risk, index rate risk, credit risk, inflation risk, purchasing power risk, and taxation risk. Because bond prices fluctuate continually, their yields change constantly.